Residential solar stocks have gotten absolutely crushed over the last year. There are a number of reasons for that. One was the changes in policy in California, net metering 3.0, that makes it basically less economical to send electricity that you produce on your roof back to the grid, makes it more economical to have energy storage on site, which I'll talk about in a little bit, where that may be an opportunity for some of these installers. But the short-term impact in 2023 was that it just killed the market in California. There were some policy changes in Europe, and actually the rest of the US held up pretty well throughout the year. But then the big headwind that a lot of these companies were dealing with was rising interest rates. Interest rates are really important for solar companies and renewable energy companies across the board because most of these projects are financed over the course of 10, 20, and sometimes even 30 years. So if interest rates go from 4% to 7%, that's going to reduce the long-term value of the cash flows that these companies are producing. So in the case of a residential solar installation, you're signing a contract for 20 years. A customer is going to pay you for electricity in years 18, 19, 20. Those payments in those out years are going to be less valuable as interest rates rise than when interest rates were lower. So that puts pressure on the margins up front because that doesn't have any impact on the cost of installations up front. And there's also cost pressure, speaking of installation costs, from rising labor rates, rising material prices. So all of these things hit in 2023 and just made for a terrible year across the industry. But have we hit a bottom? I think eventually we will hit some sort of bottom in residential solar. This is ultimately going to be a big business long term because putting solar on people's roofs, adding energy storage, adding electric vehicle charging, that's going to be a big business that somebody is going to be able to figure out and make money on. So is now the time to be buying these stocks? That's what I'm going to dig into today. I'm going to focus on three companies: Sunrun, which is the industry leader, and then SunPower and Sunnova, which are second and third place behind Sunrun in the industry. I've been following this industry for a very long time, so if you have questions about anything here, leave those in the comment section below. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start this discussion with a couple of charts from some of these companies. I'm going to start here with Sunrun's explanation of costs and value that they're creating, because there are some of these things that I put a little bit of question into when we look at where the value is being created in the industry. And there's some different business models. Sunrun specifically focuses almost entirely on leasing or power purchase agreements. So they're financing all of their projects long term. SunPower has a little bit of a financing agnostic business model. And then Sunnova is more like Sunrun from a business model perspective. So what they're saying is that the subscriber value that they are going to generate over the course of 30 years or so is going to be $50,000. $46,530 of that is under contract. So basically the present value of all future cash flows of tax equity, of customer payments, state rebates, and then you take out operating and maintenance costs. This is the present value of all of those future cash flows. The next number, the $3,772, this is their renewal assumption. This is one of the things I have questioned for a very long time, specifically with Sunrun, is they assume there's going to be some sort of renewal at the end of a contract period, which I don't think makes a lot of sense. Renewing a contract for 20-year-old solar panels is just not a great financial move, I don't think. And we have no evidence that that's actually what customers are going to do. So reporting this in your financial numbers, I think, is very questionable. It would be a little bit like Apple saying, hey, 90% of our customers are going to buy another iPhone, so we're going to add that to the value that we're reporting to investors because we're going to just assume that revenue is going to appear. If that exists, then we as investors should be able to make that assumption, not the company reporting itself. So I'll get off my soapbox there, but here's the reason that's important. Their creation cost, $46,857, and all of the numbers that I have talked about here are based on a present value at 6% discount rate. If you are familiar with what has happened with interest rates over the last 18 months or so, interest rates for long-term projects are not at 6%. They're more at 7, 8, 9%. So a more appropriate discount rate would be at least 7.5%, which is what they report here. That gives you a net subscriber value of $8,447. Subtract out this renewal that I talked about, and you only get about $5,000 in value creation. So this is really the challenge here, is the interest rate increase reduces the value that they're generating. So they're going to have to make some changes in the business model. You're going to have to reduce upfront costs. You're going to have to raise your prices. There's a number of these changes that all of these companies are having to deal with. So I'm just using Sunrun as an example here, but this affects all of the companies involved. One of the tailwinds that we could see in the residential solar industry, I'm going to look at data from SunPower here, is the increase in electricity prices for residents across the country. Now, this is going to be something that's going to be different state by state. They do have a chart here of electricity prices and then the year-over-year change. This is as of November 2023. But states like Maine, Idaho, California, North Carolina have had double-digit increases in their electricity prices. And the trend is pretty clear. After decades of prices increasing 1% to 2% a year and hovering right around 10 cents a kilowatt hour, we're starting to see some really big numbers in some of these states. And as electricity prices rise from your utility, it makes it more economical to start producing your own energy with rooftop solar and then even storing some of that energy with energy storage. And if we go to their Q4 2023 numbers, you see some of that storage growth. 76% of customers in California included energy storage with SunPower solar systems, 23% nationally. So even that national number is a major change from a couple of years ago in the solar industry. Their backlog now at 52,100 and just 16,000 customers added in Q4. So this is going to be the opportunity, is can all of these companies start increasing their sales in particularly the second and third quarter of 2024. I think that's when things are going to pick up. So the next quarterly results that we see here in about the next month is when we're going to start getting guidance for the second quarter and for the rest of 2024. That's when we could see an increase in expected installations and margin for these companies as they raise prices and kind of figure out their financial situation and the situation specifically in California and the US. And we're going to go over to Sunnova here and just talk about cash flows, because this is what all of these companies are dealing with, is the liquidity challenge that the current interest rate situation presents for all of these companies. So when you put a solar installation that costs $40,000, $50,000 on somebody's roof, you have to finance that. To finance that, you have to have money available, particularly from debt markets. So in the case of Sunnova, they're looking at investing $4.25 billion into solar systems. They would get $1.5 billion in tax equity, net borrowing from non-recourse debt, $2.7 billion, corporate expenses, and then when you add in levered cash flow, they would be about break even from a cash perspective. Next year, those levered cash flows expected to go up a little bit, and then again, an increase in 2026. But they are dancing kind of a tightrope. If interest rates are higher than they expect, their proceeds from non-recourse debt could be significantly lower than they expect right here. Credit markets also need to be open for these companies. So it's not a done deal that they're going to get all of the financing they need to do all of these solar installations. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So there are a couple of reasons to be optimistic for the residential solar installers over the next 6 months to a year. One is those rising utility rates that I talked about earlier. If utility rates continue to rise, it's just going to push more people to try to look at alternatives. What sort of options are there for residential solar, for storage, for electric vehicles? That could just expand the market, increase the total addressable market. The other thing is energy storage is an incremental value add for these companies. So whether they're financing them or whether they are selling these projects outright, adding another major component like energy storage can be a real benefit to them. There's also the opportunity to create something like a virtual power plant and be the one that controls when electricity goes back to the grid and when it doesn't. Perform that arbitrage for customers. There's going to be revenue generated there, and they're going to be able to share that with customers and take a little bit of ongoing revenue for themselves. So that could be another high margin revenue source for them going forward, especially as we see really high attach rates for energy storage, specifically in California, where I think it makes the most sense right now. But the one headwind that is worth considering is interest rates. Over the last 3 or 4 months, interest rates have not gone down the way that a lot of investors expected. That could have been a tailwind for them, but it doesn't appear that's going to be the case, at least over the next few months. Now, offsetting that partially is going to be falling costs for components in the residential solar industry. So we know that solar panels are abundant. US officials are worried about those being dumped from a lot of Chinese manufacturers, but the benefit to that is that it's a lower component cost for a lot of these residential solar installers, We may also see a little bit of price pressure on some of the major components like inverters and power optimizers. So that could be a benefit for their margins, lowering that upfront expense. And then labor seems to be a little bit easier to find right now too. So a lot to balance. This is not an area that I'm putting new money in right now, but I'm not selling my solar stocks because I do think there is going to be a recovery coming over the next couple of years. As I'm recording, the market cap of these companies is just tiny, especially SunPower is worth just $463 million. That's before we account for some warrants that were issued recently. So keep that in mind. Sonova worth $581 million and Sunrun worth $2.6 billion. So potentially a lot of value for these companies and upside for these companies if we do see more customers choosing solar because it's the most economical energy source for them. But I do want to wait to see if there's a little bit more optimism after first quarter results are announced, because the end of 2023 was really devastating for all these companies. But what do you think about the state of residential solar? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.